Today, taxing times for cryptocurrency investors. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today we look at the declines in decentralized finance, or DeFi, and also the questions relating to the tax treatment of cryptocurrency investments, relevant as we hit the end of the Australian financial tax year. Everybody involved in acquiring or disposing of cryptocurrency needs to keep records in relation to their cryptocurrency transactions, and the ATO has data matching facilities to check for compliance. But first, Bloomberg says that red flags are starting to appear in what's often been the most lucrative and volatile sector of the crypto universe so far this year. With the broad 60% or so declines in decentralized finance, or DeFi, tokens are generally in line with the recent plunge in digital stalwarts such as Bitcoin and Ether. A closer look suggests something else is at work. Many of the tokens which power applications that allow users to lend, borrow and trade crypto without intermediaries are being hurt by the unwinding of the multiple layers of leverage that underpin the transactions. The number of new DeFi user accounts opened daily has dropped to the lowest levels since the embryonic sector started hitting its stride in September, according to Nick Carter, who's a founding partner at Castle Island Venture, who used data from Richard Chen of Venture Fund One Confirmation to measure the decline. For the past 4 days, only a few thousand new accounts were opened daily, down from the nearly 40,000 in mid-May. This may spell trouble, since it's the injection of new users into the system that helped DeFi investors achieve triple-digit overnight returns on tokens of apps such as Compound and SushiSwap. Many DeFi apps essentially let users lend out their coins to new users and to earn returns on the loan. If there aren't fresh users clamoring for the coins, the yields fall. DeFi is going to be challenged because it relies on this injection of new liquidity, and ultimately a lot of DeFi yields are a function of new buyers supporting token prices, Carter said. I don't think DeFi is going away. It just might be a less attractive place to park capital in the next few months. The amount of funds locked in DeFi applications is already more than 40% lower than in mid-May, according to data tracker DeFi Pulse. The drop to $51 billion from $87 billion effectively shows money leaving the sector. Investors have been flocking into the sector because of the often instantaneous triple-digit returns seen in the past year, outstripping even the almost fourfold gains in Bitcoin. These experiments are very interesting and very promising, but that's still all they are, says Gil Luria, Director of Research at D.A. Davidson. Just like any category of startups, I would expect most of the new financial services delivered through crypto technology to fail. Many DeFi apps that exist today have a slew of inherent problems. Scores of projects lack the financial and regulatory controls and compliance processes likely required of them, making them vulnerable to a regulatory crackdown, Luria said. Some of these projects have also experienced hacks and lost millions of funds, such as Uran.finance. Billionaire crypto investor Michael Novogratz tweeted on Wednesday that the sector could be facing tougher regulatory scrutiny. Often the developer of an app and a few investors own the lion's share of the coin's supply. Popular decentralized exchange Uniswap, for instance, allocated about 40% of its Uni token supply to its team, investors and advisors. What's more, the DeFi coins have been subject to front-running using software called bots, akin to that described in Michael Lewis's Flash Boys. Many DeFi apps run on the Ethereum blockchain, whose users can choose to pay more, a so-called gas fee, to have their transactions processed faster. That opens the door to front running, where someone can see that a transaction is sitting in a queue and pay more to have their own transaction processed beforehand and make money on the difference in the coin's price. Decentralized exchanges that are a major part of DeFi have suffered from front running, which is a realistic threat to Ethereum today, according to one paper. I could essentially be the middleman with no risk, Klaus Kerwes, a consensus researcher at Vega, which is trying to fix such problems, said in an interview. The front-running risk could deter users from accessing decentralized exchanges, he said. Even with the technology, regulatory and other problems, many investors still see DeFi holding a lot of promise, though. I'd say the frenzy in DeFi is fading, but the long-term prospects remain strong, said Aaron Brown, a crypto investor who writes for Bloomberg. This is not a bubble that popped, leaving nothing behind. It's a market that got a little ahead of itself and is now retrenching a bit. Well, it could be, or it could be something more substantive here. And once again, I keep underscoring you must understand the risks if you're going to get sucked into this particular area of crypto. It is largely unregulated, and many don't understand the implicit rules that apply, so be cautious. And something else to think about are the tax implications of trading in cryptos. And here, I'll be talking about the situation in Australia and referring to the guidance from the Australian Tax Office, or ATO. And I need to underscore that this is not financial or tax advice. Go to the ATO for more complete guidance. They actually have a lot of material on the website. But I do suspect that many crypto investors have no idea of their tax obligations. And indeed, I received a request just yesterday to cover this off. So here goes. First, the ATO says cryptocurrency is generally used to describe a digital asset in which encryption techniques are used to regulate the generations of additional units and verify transactions on a blockchain. Cryptocurrency generally operates independently of a central bank, central authority, or government. And they say any reference to cryptocurrency in their guidance refers to Bitcoin or other cryptos or digital currencies that have similar characteristics as Bitcoin. So if you're involved in acquiring or disposing of cryptocurrency, you need to be aware of the tax consequences. These vary depending on the nature of your circumstances. If you have dealt with a foreign exchange or cryptocurrency, there may also be taxation consequences in your transactions in that foreign country. A capital gains tax or CGT event occurs when you dispose of your cryptocurrency. A disposal can occur when you sell or gift cryptocurrency, trade or exchange cryptocurrency, including the disposal of one cryptocurrency for another cryptocurrency, or convert cryptocurrency to fiat currency, a currency established by government regulation or law, such as the Australian dollar, or even use cryptocurrency to obtain goods or services. If you make a capital gain on the disposal of cryptocurrency, some or all of the gain may be taxed. Now, certain capital gains or losses from disposing of a cryptocurrency that is a personal use asset are disregarded. Now, that means that if the disposal is part of a business that you carry on, the profits you make on disposal will be assessable as ordinary income and not as a capital gain. While a digital wallet can contain different types of cryptocurrencies, each cryptocurrency is a separate CGT asset. So if you dispose of one cryptocurrency to acquire another cryptocurrency, you dispose of one CGT asset and acquire another CGT asset. Because you receive property instead of money in return for your cryptocurrency, the market value of the cryptocurrency you receive needs to be accounted for in Australian dollars. And if the cryptocurrency you received can't be valued, the capital proceeds from the disposal are worked out using the market value of the cryptocurrency you disposed of at the time of the transaction. And again, if you acquire cryptocurrency as an investment, You may have to pay tax on any capital gain you make on disposal of the cryptocurrency. Now, you're going to make a capital gain if the capital proceeds from the disposal of the cryptocurrency are more than its cost base. Even if the market value of your cryptocurrency changes, you do not make a capital gain or loss until you dispose of it. So that's worth thinking about if you're trading actively in a volatile market. And if you hold the cryptocurrency as an investment, you will not be entitled to the personal use asset exemption. However, if you hold your cryptocurrency as an investment for 12 months or more, you may be entitled to the CGT discount to reduce the capital gain you make when you dispose of it. And if you have a net capital loss, you can use it to reduce the capital gain you make in the later year. And you can't deduct a net capital loss from your other income. You must keep records of each cryptocurrency transaction to work out whether you have made a capital gain or loss from each CGT event. And then there's proof of stake, which is a form of consensus mechanism that requires forgers, similar to miners, to hold units of a cryptocurrency so that they can validate transactions and create new blocks. Forgers participate in consensus by staking their existing tokens. A forger who is selected to forge a new block is rewarded with additional tokens when the new block has been created. The additional tokens are received from holding the original tokens, and the money value of those additional tokens is ordinary income of the forger at the time they are derived. Other consensus mechanisms that reward existing token holders for their role in maintaining the network will have the same tax outcomes. This would include rewards derived through proof of authority and proof of credit mechanisms by validators, agent nodes, guardian nodes, premium stakers, and other entities performing comparable roles. Token holders who participate in proxy staking or who vote their tokens in delegated consensus mechanisms and receive a reward by so doing also derive ordinary income equal to the money value of the tokens they receive. And some projects airdrop new tokens to existing token holders as a way of increasing the supply of tokens, for example, Pundi X and Tron. The money value of an established token received through an airdrop is ordinary income of the recipient at the time it's derived. Some capital gains or losses that arise from the disposal of a cryptocurrency that is a personal use asset, though, may be disregarded. Cryptocurrency is a personal use asset if it is kept or used mainly to purchase items for personal use or consumption. Cryptocurrency is not a personal use asset if it's kept or used mainly as an investment, in a profit-making scheme, or in the course of carrying out a business. Where cryptocurrency is acquired and used within a short period of time to acquire items for personal use or consumption, the cryptocurrency is more likely to be a personal use asset. However, where the cryptocurrency is acquired and held for some time before any such transactions are made, or only a small proportion of the cryptocurrency acquired is used to make such transactions, it's much less likely that the cryptocurrency is a personal use asset. In those situations, the cryptocurrency is more likely to be held for some other purpose. Except in rare situations, the cryptocurrency will not be a personal use asset when you have to exchange your cryptocurrency to Australian dollars or to a different cryptocurrency to purchase items for personal use or consumption, or if you have to use a payment gateway or other bill payment intermediary to purchase or acquire the items on your behalf, rather than purchasing or acquiring directly with your cryptocurrency. The relevant time for working out if an asset is a personal use asset is at the time of its disposal. During a period of ownership, the way that cryptocurrency is kept or used may change. For example, cryptocurrency may originally be acquired for personal use and enjoyment, but ultimately kept or used as an investment to make a profit on ultimate disposal or as part of carrying on a business. The longer a cryptocurrency is held, the less likely it is that it will be a personal use asset, even if you ultimately use it to purchase items for personal use or consumption. Only personal gains you make from personal use assets acquired for less than $10,000 are disregarded for CGT purposes. However, all capital losses you make on personal use assets are disregarded. And you may be able to claim a capital loss if you lose your cryptocurrency private key or your cryptocurrency is stolen. In this context, the issue is likely to be whether the cryptocurrency is lost, whether you have lost evidence of your ownership, or whether you have lost access to the cryptocurrency. Generally, where an item can be replaced, it is not lost. A lost private key can't be replaced. Therefore, to claim a capital loss, you must be able to provide the following kinds of evidence: that when you acquired and lost the private key, the wallet address that the private key related to, the cost you incurred to acquire the lost or stolen cryptocurrency, and the amount of cryptocurrency in the wallet at the time of loss of the private key, and that the wallet was controlled by you, and also that you're in possession of the hardware that stores the wallet, and transactions to the wallet from a digital currency exchange for which you hold a verified account or is linked to your identity. Now, it's worth noting that the ATO cryptocurrency data matching program has been in place since April 2019. Under the program, they collect data on cryptocurrency transactions for 2014 to 15 through to 2019-20. And that protocol is also going to be used to collect data up including the year 22-23. Now, they're seeking to obtain data relating to cryptocurrency transactions and account information from designated service providers. The data obtained will be used to identify the buyers and the sellers of crypto assets and quantify the related transactions. And they will match the data provided by the DSPs against ATO records to identify individuals who may not be meeting their registration, reporting, lodgement and/or payment obligations. A chain split refers to the situation where there are two or more competing versions of a blockchain. These competing versions share the same history up to the point where their core rules diverge. But if you hold cryptocurrency as an investment and receive a new cryptocurrency as a result of a chain split, such as Bitcoin Cash being received by Bitcoin holders, you do not derive ordinary income or make a capital gain at that time as a result of receiving the new cryptocurrency. And if you hold the new cryptocurrency as an investment, you will make a capital gain when you dispose of it. When working out your capital gain, the cost base of a new cryptocurrency received as a result of a chain split is 0. And if you hold the new cryptocurrency as an investment for 12 months or more, you may be entitled to the CGT discount. If you're using cryptocurrency in your business, you need to keep records of all your cryptocurrency transactions. That includes the date of the transactions, the value of the cryptocurrency in Australian dollars at the time of the transactions, which can be taken from a reputable online exchange, what the transaction was for, and who the other party was, even if it's just their cryptocurrency address. You need to keep these records for 5 years from when you prepared or obtained the records or completed the transaction or acts those records relate to, whichever is later. You should keep records long enough to cover the period of review, also known as the amendment period, for an assessment that uses information from the record. In 2014, they issued 2 taxation determinations, TD 2014-25 and TD 2014-26, clarifying that Bitcoin and cryptocurrencies like Bitcoin are not money but are capital gains, CGT, assets. And if a self-managed super fund transacts in cryptocurrencies, the trustees and members need to be aware of the tax consequences. In each case, these will depend on the nature of the self-managed super fund's circumstances. Self-managed super funds involved in acquiring or disposing of cryptocurrency must keep records in relation to their cryptocurrency transactions. There are also super regulatory considerations for those trustees, members, and the self-managed super fund auditors. While self-managed super funds are not prohibited from investing in cryptocurrencies, the investment must be allowed under the fund's trust deed, be in accordance with the fund's investment strategy, comply with the regulatory requirements concerning investment restrictions. And so self-managed super fund trustees are encouraged to seek independent professional advice before undertaking any new investment in their self-managed super fund, including investments in cryptocurrencies. And cryptocurrencies such as Bitcoin are CGT assets, and self-managed super funds must acquire, dispose of, or invest in those as they would in other assets. And when a self-managed super fund engages in those transactions, it must comply with the same regulatory assessments and requirements that apply to investments of other assets. A self-managed super fund's investment strategy outlines its investment objectives and specifies the types of investments that it can make. Before investing in cryptocurrency, self-managed super fund trustees and members should consider the level of risk of the investment. And trustees and members may then review and, if necessary, update their fund's investment strategy to ensure that the investment being considered is permitted. And trustees and members must also ensure that investments in cryptocurrency are allowed under the self-managed super fund's deed. The super laws require trustees and members to ensure their fund's assets are held separately from personal assets. A self-managed super fund cryptocurrency investment must be held and managed separately from the personal or business investments of trustees and members. This includes ensuring that self-managed super funds have clear ownership of the cryptocurrency, and that means the funds must maintain and be able to provide evidence of a separate cryptocurrency wallet for the self-managed super fund from that used by trustees and members personally. And self-managed super funds must ensure their investments in cryptocurrency are valued in accordance with ATO guidance. The value in Australian dollars will be the fair market value which can be obtained from a reputable digital currency exchange or website that publishes its rates publicly. The value of cryptocurrency can change constantly, of course. For the purpose of calculating member balances at the 30th of June, the ATO will accept the 30th of June closing value published on the website of a cryptocurrency exchange that reports on historical cryptocurrency values. And with certain exceptions, self-managed super funds are prohibited from intentionally acquiring assets from related parties. The exceptions include listed securities and business real property when acquired at market value. Cryptocurrencies such as Bitcoin are not listed securities, so do not fall within these exceptions, and they therefore cannot be acquired from a related party. It follows that self-managed super fund trustees and members, being related parties of the fund, cannot make an in specie contribution or other transfer of cryptocurrencies to the fund. And a self-managed super fund must be maintained for the sole purpose of providing retirement benefits to trustees and members or to their dependents if a member or trustee dies before retirement. It's unlikely that a self-managed super fund will meet the sole purpose test if trustees or members directly or indirectly obtain a financial benefit when making investment decisions and arrangements. For example, it may be a breach of the sole purpose test where affiliate fees or commissions associated with the fund's cryptocurrency investments are paid to a trustee or member personally. And where a trustee or member satisfies a condition of release, the self-managed super fund can make an in specie lump sum payment by way of transfer of cryptocurrency, but pension payments must be made in cash. And trustees and members will need to consider the fund's trust deed and any CGT implications associated with the transfer of assets such as cryptocurrency. So, to summarise, this is a very complicated area. Firstly, most times it'll be a capital gains transaction event on the sale of a particular cryptocurrency. That is something you need to account for. And clearly, there are also some situations where it'll be income rather than capital gains tax. And if you go down the rabbit hole of investing in cryptocurrencies via self-managed super fund, there are a bunch of additional things that need to be thought about. The bottom line is this. This is not straightforward. You may well need to get professional advice to understand the full tax implications, but you need to keep records, good records, and also make sure that those records are up to date. But remember this, the bulk of the time, the transactions that you will need to report will be capital appreciation or depreciation based on the values as they move around when you sell them. Plus, of course, you may be able to offset some costs relating to the management of those cryptocurrencies. Once again, this is not straightforward. So I recommend that you read in detail the guidance from the ATO and then potentially get specific financial advice from a financial advisor. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.